Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. So much is happening right now with mortgages. Interest rates is a hot topic, and people want to know what they should be doing. So we've got ourselves a mortgage expert on the podcast, and I probe and push to get the best advice for you so you can make the best decisions now and moving forward.
Yes, welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a company that buys more than £100 million worth of property per year on behalf of our clients. You can find out about that at propertyhub.net/invest. And every single one of those clients always wants to know what's going on in the mortgage market. We talk endlessly on this podcast about the benefits of working with a good mortgage broker. Well, today, everyone gets that special experience because we've got mortgage broker extraordinaire Nick Shepherd on the show.
It's time for our news story of the week now, and as we edge ever closer to the budget, the headlines are ramping up. There seems to be a different news story every day. One that's caught our eye, though, is from The Telegraph, and The Telegraph are reporting that Britain's rental market will lose 1 million homes in the next decade if Labour go ahead with capital gains tax increases. Will that happen, first of all? It's not a done deal, although a lot of people are reporting it like it's a done deal. We will see. In this report, it talks about how capital gains increasing to 45% would mean a mass exodus. And it's true, there probably would be a lot of landlords who would leave if that was to be put in place. But they would be the older generation of landlords, because the vast majority of newer landlords or property investors have invested through limited companies. And that shouldn't be an issue for people who've invested through a limited company. It's for the people who've invested in their own names, and that will impact them. Personally, I have in both, so it's not something I'm exactly welcoming or hoping happens, but I'm not overly worried because over the last few years, my portfolio has been built up in a limited company like the majority of others. So let's see what plays out. I think it's one of these things that you shouldn't lose sleep over until it's happened. And when it happens, then you can make plans. And once the budget is announced, we'll be reacting on the podcast. So make sure you join us for that. But also the weeks that follow, if we need to take different strategies as property investors, we'll be guiding you through that process as well. So the podcast is absolutely essential listening after the budget and the few weeks after as well, because we will be reacting and we will be guiding. So we are very lucky today to have Nick Shepherd from Framework Mortgaging, a true expert with mortgages. And it's lucky, Nick, that you're an expert because there's a lot going on, as always, it seems, with mortgages at the moment. So much I want to get into. But let's get straight into the meat of it. Let's not mess around. What is the state of the mortgage market at the moment? How would you describe it? And obviously focusing on buy-to-let in particular.
Pricing is competitive, and some products point to lenders wanting to be competitive. Capacity-wise, it isn't great, though. Numerous lenders have lengthy turnaround times, and the specialist market averages around 5 to 10 days SLA. So it's 100% not a passive market, and encourage all clients to engage and collate documents ASAP. To conclude, I have more concerns operationally than with rates.
I mean, it's great news that products are competitive, but I must admit, from the insides inner workings of Property Hub Invest, I hear you. Like, I know how slow some of these buy-to-let mortgages are going at the moment. And you touched on people being prepared, and I think that's some great advice. But is there anything else people could be doing? Because it's not just you buying, right? You've got a seller involved, and the sellers can quite understandably get really frustrated with how long this takes. So is there anything that could be done other than being prepared to make the best of what is a challenging situation?
Starting early and being proactive really helps. We have a really simple kind of 3-step process to get an application in. And the first step, which is the fact-finding process, is where clients kind of engage and have a lot of the heavy lifting, have a lot of work to do there. And the more we all engage together and work as a team there to collate documents, prepare your case, and to simply just prepare you for application, the more thorough that process is and the slower that process is, the quicker time you will have during the application process. Perfectly packaged cases do get through quickly. So we've had one case at the moment that's taken 3 weeks, but a similar client elsewhere, the packaging wasn't so great. It can take 6 to 7. So that first step, the fact-finding process, where we really understand who the clients are, where they are, how they've earned their money, and more importantly, We know the detail behind their portfolios is extremely important.
So interest rates have obviously dropped recently, but there is lots of rumblings that they are going to be cut further. And I don't think too many people are going to complain about that. Maybe savers, but not me as a property investor. What are your thoughts on that? Do you think cuts will happen? And if so, how aggressive?
I'm not too sure they're going to be really aggressive. I've always said that 4.5% with a flat fee for banks and building societies is a great place to be before the end of the year. I think we're getting there, but I don't think lenders are in a rush to do it. Like I mentioned, a lot of lenders, especially in the specialist market, struggle with capacity. There's a real shortage of underwriters out there, so lenders can't drop rates to encourage lots of business. So 4.5% with a flat fee by the end of this year, start of next, I think it's a great place to be. And that probably is quite aggressive, actually, when you consider that flat fee is probably reducing from 5 to 3%. So maybe the focus is on the product fee instead of the interest rate.
So 4.5%, is that what investors should be striving for now, or is that what you think will come? Where's the market at today?
Well, limited company with banks, we're at late 4%. So 4.5%, yes, is achievable before the end of the year. So 4.5% with the flat £2,000 fee. But always remember the banks and building societies that they're very particular on who they lend to and what properties they lend to. So banks and builder societies aren't open for new build flats, high-rise flats, etc. And that's where you have to enter the specialist market. The specialist market does start at 4.5%, but that's where you bump into the product fees.
So the dreaded product fees, the arrangement fees, how are they at the moment? Because you've talked on the podcast before, Nick, about how it can be misleading, the headline rate, because you can have a headline rate that looks really attractive, but then you go into a little bit of the detail and you suddenly see a whopping arrangement fee there. So have arrangement fees started to calm down, or are they still pretty punchy?
Fee product starts around 5.9%. There's some really good products out there for around there that you can use for larger blocks, new build flats, etc. So 5.9 with no fee. But obviously, if you want to preserve your cash flow, if you're buying a flat, for example, because you're navigating through service charges, etc., you can push that 5.9 down to about 4.5. But again, you're exchanging that low rate for a higher product fee. So you're pushing and pulling between interest rate and product fee to get your cash flow to where you want it to be. Like you say, I think the headline with the product fees, they're shocking. There's no getting away with that. But when you break down the overall cost over 5 years, high fee to low fee, you'll see that in some instances, the difference in cost is only maybe £1,000 over 5 years. So it's really important that clients get clarity of how much the monthly and the overall cost is between all of these products. For example, I was talking to a client last week who was really against the large product fees. But when you broke down the pounds and pence in the black and white of the figures, actually went with the product fee because they wanted to maintain and preserve their cash flow at a certain level.
Yeah, makes sense. I want to come back to something you touched on a moment ago, and you mentioned about capacity of the lenders. And if they are at capacity, then they're less inclined to be aggressive with their rates, because if they've got enough coming in, then they don't need to be really competitive. But the other thing beyond that is if the market continues to improve, which seems to be heading in that direction. It's been a fairly good year, but I feel sentiment is improving with investors. So if that's the case and more people are coming to the market and more people are attracted to buy to let, how are these lenders going to cope?
It's a very good question. I was speaking to one lender, it was about 3 weeks ago now, and the BDM said they're trying to employ underwriters, but they can't find the underwriters. So you are right, there are capacity issues, and this is the specialist market. So I just dropped some names in. So there's not really capacity issues with the likes of T&W, Fleet, Harrigan, all these guys. But when you're moving into the Keystone, CHL, TML world, that's where you do see the capacity issues. Remember, they're smaller enterprises, so they do work within capacity. So it will be a challenge. It will be interesting to see how it goes. Lenders do want to lend. They do want to grow. They recognise the opportunity in buy-to-let, especially in next year. And we can see that with the banks entering limited company. But you are right, lenders have got to operationally get it right to cope with the influx of business. So The want to do that is there, and that's the most important thing, and we'll just see how it goes. But yeah, capacity is a real problem in the specialist market. But again, it's only a problem if clients and brokers don't prepare. So we know how long things take. Applications take 4 to 6 weeks from application to offer. You just remember, before that point, you need to prepare, collate documents. So it's really important to engage with brokers early. And the capacity issues that we're mentioning might not be noticeable because you've prepared, and if we're all patient during the process and well informed and the communication is good, it's not as painful as maybe I'm alluding to.
Something that might be painful is for people with property in the southeast, or this scenario might play out as well if someone's not raised their rents. But this is the issue of rents not being at the right level for the price of the property. And I know London and the southeast particularly suffers from this. So they can't get the 75% loan to value. So other than attempting to raise rents, which the market may allow, the tenants might not be happy, the market may allow it. If the market allows it and it gets up to enough, then fine. But even with increasing rents, and they still aren't at the right levels in terms of stress tests, what can they do? Do they have any options? And building on that, Nick, what are the current stress tests? It's been a while since I've looked at them. Could you educate me and everyone else listening about what the lenders are looking for in terms of stress tests?
Yeah, and personal name mortgages have tougher stress tests, so the ratio's higher. So instead of 125% in the limited company world, it's 140 or 145% in the personal name world. And that ratio is dictated by the client's income. So I would run your numbers at 145% ratio with your stress tests. But the only thing that clients can do are reduce your mortgage balance or use a lower rate alongside the rent increases. So they're the three components of the calculations there. This is exactly why the low interest rate and high product fee products exist. Lenders do want to, they don't want clients to be in these situations. They do want to encourage more borrowing. And the way that you do that is by pushing your interest rate down as low as possible and taking the burden of the debt away from the interest rate and putting it on the product fee. It's an unfortunate situation to be in. There are options. For example, if a client's got a portfolio, you might be able to refinance elsewhere. There's a solution with everybody, but just focusing on that core calculation, the lower the interest rate, the better.
Is there any type of mortgage that you can take that will ease the stress tests? For example, like a 5-year product rather than a 2-year product? Does that start to make things a little easier?
Absolutely. So 5-year stress tests are typically lower and easier to borrow more. So 2 years and tracker mortgages that have tougher stress tests, and they often lower the interest rate by 2%. So yes, 5-year will encourage more borrowing.
And for those listening, if you don't understand what a stress test is, maybe you're new to property investment, it's taking your mortgage payment, the amount it is, and your rent needs to cover 125% of that payment each month, or 140, depending on the stress test involved. Nick, I've talked about sentiment already, and I'm an optimist, but I feel it's based on the conversations that I'm having with people in the market. Like you, I'm deep in the market. We're both moving different circles. They overlap, obviously, at times, but you deal more with the lenders and you're one-on-one with a lot of landlords as well. How would you describe sentiments at the moment in the market? Do you feel it's changed from where it was, say, a year ago and even 6 months ago? I've noticed a real difference. I certainly felt it's dramatically improved from 12 months ago, and even 6 months ago, I feel it's moved in the right direction. How do you see it?
The headline is, yes, it's better. It's better, especially over the last 6 months. But because I'm behind the scenes, I can see that it's actually quite tender. So I'm always naturally quite conservative with my outlooks. I feel that's my job to be that with clients, to maybe pour water on some clients' kind of views of the market, just to make sure they get with the right product and have the information they need. But yes, rates are getting better. Lenders want to lend. More lenders are coming into the market. Like we said earlier, banks are coming into the limited company world, which will incur lower product fees. So lenders recognise the opportunity. The rates are getting better. Lenders want to do better. But obviously, we've got the wider global situation going on at the moment, which makes it a little bit tender. We have the lender capacity issues, which increase interest rates or lead to increasing interest rates overnight. So I can see all these, the more tender side of things behind the scenes. So yes, it is positive. But I think if clients are proactive, they can get a competitive rate. But I'll say rates don't hang around forever.
No, they don't. And that's why I love chatting to you, Nick, because it just seems to change all the time. I was a bit naughty then because I know 6 months ago what your view on the market was, because I asked you a similar question at a Property Hub Select event. And even though you weren't exactly bouncing around then with your answer, compared to the answer you gave 6 months ago, you certainly weren't optimistic about where things were. Not about the market itself, more about the mortgage market and how challenging it was at the time, and particularly with valuers. And actually, that was a huge, huge problem. And I'm not underplaying this. It was a huge problem at the beginning of the year, down valuations. I know they still happen, but is this as bad as it was? Because, I mean, I don't know of a time as bad as it was at the beginning of the year. There was some ridiculous down valuations happening that I was witness to, some crazy stuff. And even with actual proof, surveyors weren't interested in adjusting the valuations. Has that silliness maybe not stopped, but improved? I'm not hearing as much now. What about you?
It's definitely improving. It's like lender sentiment. It's improving and it's there, and, tender behind the scenes. So I think with surveyors, to keep it really kind of high level, there were two sentiments when the surveyor used to go out to a property. There is no comparable evidence, but I will give you your valuation, because they could see the value in the asset, see the regeneration, and see the future value of a property. Whereas the start of the year, maybe they didn't kind of agree with that and put in that mindset. It was just, there is no comparable evidence. I think surveyors were cautious, to say the least. That caution's maybe going slightly, but I think they've probably got a new way of working with surveyors. So it's always a bit of a tender process, but yes, it's getting a lot better. We've seen, especially with more mature areas where there is strong comparable evidence, we're not seeing much disagreements with the values at the moment.
It was the rental down values that got me, because I remember seeing cases where we were able to produce evidence that the rents were as stated, and not just by comparables, by actual ASTs. And they still wouldn't change their minds. Like, it's just crazy. Like, actual evidence that somebody is willing to rent this property at the amount said, but you're saying it's going to rent for less. Just ridiculous.
I think that sentiment was driven by fear. And I think if you're a surveyor providing valuation to a bank, I think when the market's very, very tender, they're always going to be cautious. So as the market gets better, as everyone's encouraged where the economy's going, where the property market's going, that caution's going to hopefully fade off into the background.
And finally, I have to ask, because it's a big event, at least here in the UK, we have the budget coming up, and there's mainly, I'd say, more nervousness than optimism around the budget currently. Hopefully we're all pleasantly surprised. But focusing on mortgages, do you think the budget's going to have any impact on the market over the short and long term? Is there anything you're expecting to come out of the budget that's going to affect what you do?
The budget is undoubtedly going to be a landmark budget. We only know one thing for sure, and it's that government plans to raise taxes to plug the 22 billion black hole left behind by the previous government. Two things on the hit list seem to be capital gains tax and pension relief, and landlords will also fear for a wealth tax. Taxing landlords doesn't really seem to make much sense, as it incentivise people to sell, leading to fewer properties to rent, and the ripple effects it will have from there. And the wealth tax will drive out business and talent from the UK, and I think that's a real risk. Income tax seems like a logical solution for me, as it simply doesn't suppress wealth creation. We all hope the new government has consulted with the markets this time and is doing everything possible to keep the positive base rate and inflation momentum.
I hope so too, Nick. We'll find out soon.
Okay, time now for Hub Extra. Time to just pack a little bit more value into the show before we let you go. And this week, if you're not into AI, I'm sorry, it's another AI one. I feel like we've done a lot of this year, but that's because so much good stuff has been going on. And this one is a new ChatGPT feature. It's advanced voice mode. So if you've got the ChatGPT app, you may have had little conversations with it in the past, and it's been okay. It's been pretty good. But at some point in the middle of this year, they released a demo showing a new voice mode that was coming and all the incredible things it can do. Now, tech demos tend to overpromise, and by the time you actually receive the feature, it turns out it can't quite do some of the stuff that they were showing in their carefully curated demo. This is different because ChatGPT's new voice mode has landed and it is amazing. It does everything the demo showed it could do. It's just like talking to a real person. It'll sense the emotion in your voice. It'll change its emotional tone. It will interrupt you. You can interrupt it. And the responses are instant. So it truly is like a conversation. It doesn't feel like you're talking to an AI. Just eliminating that pause completely changes how it feels. So at the moment, I believe this is only for people who pay for the premium version of ChatGPT. So if you do, then go check this feature out because you might not have noticed it was there. I didn't realize it was there for a couple of weeks. Give it a try. Use it for something like brainstorming or planning. That's the perfect use for something like this. And if you don't pay for ChatGPT yet, then maybe that'll push you towards it. I happen to think it's incredible value. But everything that paying subscribers get ends up being released to everyone eventually. So at the very least, you can be excited about what's going to be coming your way next year.
Yeah, the paid subscription for me, Rob, is a no-brainer. But talking about being excited, I'm excited about next week's episode. Not necessarily excited by the budget, we'll see how we feel, but I'm excited that we're going to be quick to react to it. And next week's episode, we will be reacting to the budget. Hopefully it's an episode of celebration. We will see. Who knows? But what we do know is we're all going to find out soon enough. So next week, we'll be reacting to the budget. Do not miss that episode. And of course, we'll be back with Ask Rob and Rob on Tuesday. And we'll be in the Sunday Times answering your questions in the home section, so do check that out. And as we said already, we're back next Thursday with the Property Podcast. So until then, take care, have fun, bye-bye.
Bye-bye.